That lends a lot of credibility. If you come in and can be upfront and honest and say, actually in this application, I think this product over here that I don't represent would be better for you. That all of a sudden now you become a trusted advisor rather than a salesman.
And I often say that we have all the requirements of space, right? Because it has to go underground and send us data from miles and miles away, and it has to work. Like, failure is not an option.
We'll put on, a standard mule shoe. Ours is slightly different just for that, but it's, everybody's got one.
The top drive and the drawworks really don't care whether the electrons coming at it are from a joystick or a PLC.
The panel, what you see here on the left, which is now controlled by one of my students, is showing you actually the control of our brakes.
As of now, geothermal is a pretty small market.
If you have tortuosity, the casing will be up against the side on part of the well. There won't be any cement there. The cement will have crescent around it.
So managed pressure drilling, it's been defined as a process to precisely control the pressure profile in the wellbore.
The key is being transparent with our clients in this case. So tell them what happened. If we had a failure, tell them exactly what happened. Whether it's our fault, whether it's whatever the issue was, we need to be transparent.
I think it's very important for everyone in the industry to know what's out there and kind of what's happening downhole as well.
I've probably worked on over 40 different performance limiters in my career. If I miss any of those and the computer is raising weight on bit and I miss any of those, I have a train wreck. The computer's going in the ocean.
Here's your new colors, here's your new thing. We won't do that at all.
Here's the tattoo you need to get.
Yeah, here's the tattoo. Sorry about the last one. We used to fake that all the time.
Hey everybody, and welcome to the show. This is the Vidor Locksmith Show, where we're unlocking the secrets to success one interview at a time. I am super excited about today's show because it's not first thing in the morning. So I got to do some other things this morning, take care of some stuff, and then come back and we're doing an afternoon show. Our guest today is David Ramsden-Wood. You may know him as he was previously a, I don't know what you would call it, a user, a person, a content creator on LinkedIn. But now he's coming back. He's on LinkedIn Live via the Gibson Reports Vidor Locksmith Show. So we are breaking all kinds of rules. We'll definitely get into that today. We've got a lot of talk about. I'm not seeing any of the comments coming in, but I know they'll start rolling in here pretty soon. Guys, let us know where you're watching from. If this is your first episode to ever watch, let us know. If you're somebody new, we want to be able to give you a shout out and give you a little thumbs up. Thanks for watching the show. We do appreciate it. This is the month of November, and I am thankful. I'm thankful for all of those out there that do watch the show, that participate in this. We're essentially trying to be able to educate the industry on what all's going on around us, and David is definitely an excellent person to be able to do that and keep us aware. It may not always taste great, and hope is not a plan, as he says, but the information that we're putting out there is definitely stuff that you need to know, you need to be aware of so that you can make proper decisions either in business and or in your personal life going forward. Let's see here. We've got Ricardo Borjas. Ricardo, thanks for being here. He's always tuning in. I do appreciate it. Daniel from Tanzania. I think that's a new one. It might be the first time somebody's ever watched from Tanzania. Hey, awesome. Felipe from Brazil. Thank you, sir. I do appreciate it. Rafiq. And then LinkedIn user, and he knows it, a.k.a. Scott McNeil from Cold Wet, Surrey, England, because I have nothing better to do at 7 p.m. on a Friday night while in lockdown. Well, thank you, sir, for taking your lockdown moment and being here with us. We do appreciate it. We've also got Lee House. Lee, thanks for being here, man. He's always tuning in for these shows. All right. Well, it's a little bit slower than normal, but that's okay. It's not about the numbers. It's about helping you guys out there that are out there watching. And we're trying to get through this a little bit quicker. I've gone back and watched some of my previous ones, and I tend to talk too much at the beginning. So, Eric, thanks for joining us. So as some of you guys know, if you've been watching the show here recently, I've got an employee that's working for me. His name's Fahim. He's absolutely amazing, super passionate about our industry, very driven and determined to be able to do whatever it takes to get a job done with very, very little supervision. I do not have to call this guy, but maybe once a week, and he's just been turning out amazing stuff. I know personally that we will not be able to keep him here at Gibson Reports forever. He's bound for greater and better things. So I ask all of you, please, if you know of anybody that's looking for a data scientist, a data analyst, artificial intelligence, somebody who knows how to use Python, right? This is the person to be able to hire. And I do appreciate you guys taking the time to be able to watch it. So JP Warren, hello from the 18th T-Box. You're already on the 18th? Well, I guess it is 1 o'clock. Sorry, I keep thinking it's like 10 a.m. Taylor joining us, Aaron Baxter. Oh, man. We're doing good. Wish I knew. Brian Munn, he's one of the Viper Group guys. All right, guys. So let's go ahead and pull this one up here. Let me see if we can find it. This is your 60 seconds with Fahim. Yep. Take it away, Fahim.
Hello. Hi, everyone. Thanks for tuning in. So I try to keep these 60 seconds, but I always...
Oh, crap. Sorry, my bad.
So today I want to talk a little bit about chatbots because I've been looking into chatbots and things like that. So they're actually very widely used, right? You can use them for like customer support. You can use them within your organization for like ops stuff, just, organizing stuff. So, they're pretty useful. And I guess like any time in your career, you might have to end up building one just as like a side thing to make some stuff happen automatically or just make things smoother, right? So if you were trying to build it with Python, I'm just going to mention quickly this one library that is really useful to build chatbots. It's called Nltk, which is short for Natural Language Toolkit. So yeah, since we are keeping this short, I just mentioned the name of the library. It's called Nltk. It has tons of like built-in functions, already trained models, semantics, everything built in. So you can kind of like play with it and just build a better version of your thing, I guess. But yeah, definitely check it out if you're thinking about chatbots or making things that can respond to, human language or help you do stuff. And Python, check out Nltk. So that's it. That's your minute with Fahim for this week. Thanks for watching.
Man, I am off my game today. I think by starting at 1 p.m., this has completely thrown me off. I'm not getting all the buttons down like I normally should. Guys, if you guys haven't, I've got one thing to be able to request. Please go subscribe to the YouTube channel. We're trying to do a live stream remotely, and I can't do it until I get hit 1,000 subscribers. So that's all I'm asking for. I'm not asking for any money or anything like that. Damn chair's in the way. All right, it's Friday. I'm ready for the day to already be over with. Sorry to be coughing on screen here. So we're getting ready for the How It's Done. If you guys haven't checked it out, go check out How It's Done on the YouTube channel as well. We've already got a handful of episodes filmed. We've got a couple more coming up that we've been talking to and getting signed up and ready to go. So we're really excited about season 2. This is going to be a lot of fun. I should say this. There are a couple of different operators that have told me that they distinctly watch these episodes to be able to understand more about the products of that particular nature and of the companies that are presented and in those shows. So if you want to be a part of it, get in touch with me. Let me know. Here's the intro for it. Right after this, we're back with our guest. All right, and without further ado, we bring in himself, Mr. David Ramsden-Wood, hot take of the day. David, thank you for being here today, sir.
Good to be here, David. Nice to chat with you again. It's been a while.
Yeah, between you and Fred DePriest, y'all are the two most popular people here on the show. So,
well, it's great to be back on, and I see you've really upped your video animation game. With the beginning, well done. You've been generating a lot of good content and a lot of great education, and so commend you for putting that out there. And to everyone who's joined in on LinkedIn, it's nice to be back on LinkedIn.
So let's get right into it then, man. Tell me, what happened, what's going on. There is a link for anybody that is watching. There's a link in the description of this event. So if you're on YouTube, it's there. It's probably down in the description. If you're on LinkedIn, it's at the top right. You just hit the see more button. It'll be up there with the hashtags and stuff. And if you're on Facebook, I don't know why you're on Facebook.
It's a great question why someone would be on Facebook. Well, so for those who haven't followed me before, maybe saw me on LinkedIn, and like my brother-in-law the other day said, you haven't been posting your hot take of the day. I said, well, dude, I've been kicked off LinkedIn since like September kind of time frame. So what happened was, as people know, obviously I'd started out 2 years ago posting primarily on oil and gas stuff. Talked about supply, demand, rigs, rig count, crisis of balance sheets, peak oil supply, all the things you and I have talked about before. When COVID hit, obviously because it's so interrelated to oil demand, and even in March, I was looking at the data, and I'm a data scientist as well, and the data didn't seem to justify the actions that politicians were taking. And the more the lockdowns happened, more I was integrated into an anti-lockdown look at the data. Well, LinkedIn, without any warning, sent me a note one day when I couldn't log in and said that my account's been restricted. And they flagged 4 posts, which are on my website, www.hottakeoftheday.com. I've put it out there. But they flagged these posts, me saying that there's virtually zero chance of you dying of COVID if you're healthy and under 65. Now, the CDC itself knows that under 49, the data is 99.92%. If you're between 0 and 19, it is 99.997% survival rate of this. They flagged it as false information, and they banned me. And then I appealed because I was kind of thinking it was a joke. And they said there's no appeal. You are indefinitely restricted from the platform. So we did hire a lawyer.
Whoa.
Yeah, we did. And we've sent legal. If you'd like to read that message. And so I'm going to pivot to like the importance of this topic in a second.
Yeah.
But in the show notes, I think there's a link. Breezy Carlson with the Kuiper Law Firm is a friend of our show. She's the lawyer that wrote the letter. So the 7-page letter response that we sent to LinkedIn is out there. It's on LinkedIn. And I would encourage those of you who are on LinkedIn to question the following. Do you think that views should be an echo chamber in social media, or should discourse and discussion be allowed on social media platforms? To me, I believe that the more we have debate and discussion, the more we learn. And so I'm deeply concerned about censorship. If you are too, like Breezy's post and post your own hot take of the day on why you think that censorship is bad on LinkedIn. And hopefully we'll have a little free DRW and get me back on the platform so we can get back to discussing really important issues. So that's the background of the LinkedIn ban.
So for those that don't know, I know the answer to this question, but you're still posting the hot take of the day. Where can people still go and find that?
Yeah, so we have a podcast that you can follow on Apple or Spotify or whatever called #HotTakeOfTheDay. This week's guest, we had Ivor Cummins, who's the Fat Emperor, and wrote a book called Eat Rich, Live Long. But he's also very, very anti-COVID mathematically because of all the reasons. So we have a good conversation about COVID, health, comorbidities, and getting your diet right so that your parents can live longer through non-medical interventions. So, but we do that. And then the website's obviously www.hottakeoftheday.com. I have not been writing as much because honestly, like others, I'm a little depressed and I'm worn down from the beating that we're taking in oil and gas and from the COVID lockdowns. So the inspiration to write has been a little bit less since I got kicked off LinkedIn.
So for those that don't know, we were talking about this a little bit before the show. The kind of the impetus to being able to have today's discussion was a little bit of a back and forth banter between myself and David on LinkedIn, which I now can't find to be able to go back and reference because of what we just talked about. But I know that it was in regards to like Q4 being kind of like a slaughter fest. And then also we decided to like, I said, hey, let's come on, let's do this. And he pushed off and said, no, let's do it after the election because that's where, we're going to see a lot of changes. So with that, David, I'll throw it back over to you. What have you seen here in Q4, and what have you also seen as far as the election and how that affects the economics of the oil and gas industry?
Absolutely. So the election was interesting, obviously, and I don't care if you're a Republican or a Democrat. Like, you know, we went through a process and someone won, someone lost, even though we're not really talking about that yet. What I find interesting is, you know, the market, and I mean the overall market. First, it was, well, a blue wave is bad because taxes are going up and regulations are going up. And then it was a blue wave is good because we're going to get stimulus. But then it was not a blue wave is good, but splitting the Senate is good. So then the market should go up. And then Tesla gets added to the S&P, and that's good, even though it's being added, so the stock price goes up 20% for no apparent reason because the business didn't change. But that's good. And gridlock is good, and stimulus is good. But stimulus is like, we don't need stimulus, but it's good. So it all goes up. And so the election, to me, the pieces that we're missing is, number one, in Georgia. Now this is a big if. I am not being a conspiracy theorist, and I'm not being a tinfoil hat person. But if you believe that there was some level of fraud in the election, that's a big if. But if you believe it, do you not believe that the 2 Georgia Senate runoffs are going to include the same level of fraud to make sure that Democrats win the Senate and therefore have the majority? Because if they swing those 2 seats, then it would be a democratically controlled Senate, House, presidency. And so I think that the market is underplaying that, especially Republicans who believe that there was some cheating. So that's number one. That's January 5th. Huge thing to watch. Number 2, Biden announced today that he's going to re-enter the Paris Climate Accord. And I saw on Twitter that so far year to date, the U.S. has declined CO2 emissions from last year by 9%, which puts us at 1983 levels for CO2 emissions. And you know what's happened to climate change in 2020? Absolutely nothing. Because even with an entire global lockdown, nothing has changed from the narrative. So walk me through how joining the Paris Accord and having to repeat 9% CO2 reductions every year from now until 2030 to get 25% below our 2005 CO2 emission level. Walk me through how that's going to be good for our economy. So I think that that's the second one that needs to be followed. And then the third was this debate, and I had Ellen Wald, who's written for Forbes and wrote the book Saudi Inc. I had her on the podcast and we talked about this. But Biden and the more Kamala was very much for banning fracking. The Kuiper law firm and Breezy in particular, and I talk about this a lot, there isn't really an executive mandate that like Obama kind of proved this. He can't ban fracking, but we know he can regulate methane so that if you eliminate emissions, that's a huge impact on our industry. You could use an EPA action to ban using fresh water. That would be a big deal. Or you could raise the bonding, like per well, you need $25,000 or $50,000 per well you drill as a bond to pay for it when you abandon it and to cover all the other wells that you have. All of those are regulatory actions. And for those who were under the Obama administration and had a business in 2008 to 2016, they can attest that regulations are going to get insane and very hard to comply with. And I personally have been shocked because in spite of all of that, energy, with the news of the vaccine, Exxon was up 20%, Chevron's up 20%, oil's up 15%. It's like happy days are here again. So I think the market is missing a whole bunch of risk.
So what do you think about, though, we've actually got this question that just came up from Gary. What about federal lands? Can they limit what takes place or what operational techniques are used on federal lands?
Again, I am not a lawyer, and I know that there are lots of law firms, including Kuiper, that have talked about this, but there isn't executive action that could be taken. So theoretically, they could pass Congress. They could change appointments to sort of like do a study. They could do like a moratorium on new permits. I don't know what they could do for existing permits, but clearly there's some open questions around what's going to happen on federal lands. And that impacts, like, the best parts of the country that are developable right now are in Lee and Eddy County, New Mexico, where there's a huge amount of federal land, and it doesn't even need to be like, because they're all scattered. There'd be a 160 a Fed and a 160 a state and a 320 a fee. But when you put it all together, because everyone needs to drill 2-mile wells to be economic at $42 a barrel, now all of a sudden every single thing you need a federal permit for, even if it's just a fraction of a land, can't be drilled. And so you're going to end up stranding federal land sometimes, and parties won't work with each other to drill long wells. It's just bad for our industry. So, I mean, it remains to be seen. I'm pretty concerned.
I mean, it's a very impressive stat. I think there was a stat that came out, or I've seen numerous times about how much the BLM land and the drilling that takes place on those, and how much that funds New Mexico's like education and subsidizes that. So
huge. I mean, billions of dollars a year in a relatively low populated state with a huge amount of indigenous people who live there. The last time I checked, I think it's 33% of the population is Native American indigenous. Huge economic implications when you shut down our industry. And again, I think that it's all well and good that people are saying, oh, we need lockdowns to stop the virus, but no one's asking like fatality rates. And they know it's all well and good, we're going to join the Paris Accord, but no one's talking about, like, it's not always windy, it's not always sunny. You need, like, no one expects to turn the light on and nothing goes on for like 12 hours. And if you own a Tesla, you need electricity. If you own 4 Teslas, you need to upgrade the electrical infrastructure in your house by so much. And no one's talking about that. You need natural gas to back up wind and solar, because batteries don't exist. And if you did have batteries, the rare earth minerals that would need to be mined would have such a large environmental footprint. Like, what are we doing? What are we doing? So we need to be a lot more aware of what the federal government is going to do. And I think it's very clear that they plan on taking powers and adding regulation that's going to be bad for our industry.
So let's talk about that a little bit. As far as, you know, you were saying that there's a lot of risk out there in the industry. What do you see going forward as far as like E&P operators? Should they, you know, scale back any BLM projects, or, you know, obviously, you know, things in Colorado have always been, you know, tough for the E&P companies there. Do you see just from a regulatory standpoint, some of the companies pulling back?
I mean, so yes and no. Now in Colorado's interesting because most people will remember there was Proposition 112 in 2018, which the industry spent $30 million to defeat. And very similar to what we saw happen in the 2020 election, the people who are voting for things are voting for the not in my backyard. So for instance, there was a gray wolves thing passed. And everyone where they're going to reintroduce gray wolves doesn't want gray wolves because they eat livestock and children. And everyone in Denver voted to bring back the gray wolves. And so I talk about Proposition 112, and everyone in Weld County, where you actually drill wells, was in favor of all the great things oil and gas do. Everyone in Aspen, who is like 150 miles from oil and gas development, wants 2,500 foot setbacks. I'm like, you already have like 300,000 foot setbacks in Aspen. What are you doing? But nonetheless, it got defeated, and immediately following, the left went about passing Senate Bill 181, which changed the composition of the COGCC. And just in October, they unanimously recommended to change setbacks to 2,000 feet, even though the 2,500 foot setbacks had already been put down. So the reality is regulation is going to continue to tighten, and that if they fail, they'll just come back. So I don't think that companies can afford to slow down. If they have federal land, I think they have to high grade it and drill it first. What is a real issue is, you know, if you look at the strip right now for oil, it's 42. The week before the election, everyone had thrown the towel in. Oil was 36. They said demand is going away. You know, there's so much inventory everywhere. Lockdowns are happening. This is horrible. Then there's a vaccine, which isn't available for another 7 months. And lockdowns will happen between now and then anyway. And everyone is rallying oil to 42. So I think that there is too much oil in the world. OPEC has shut 7.7 million barrels a day still. Inventories are high around the world, and we haven't even rolled into the second round of lockdowns. And so when all of that comes to pass, we're going to see, I think, lower oil prices, which is going to be very, very bad for balance sheets. So I think companies need to really restrain their activity in Q1 and Q2 and Q3 and Q4 of 2021 until demand actually recovers and the surplus of oil actually is bled off and OPEC has actually flooded the market with their product, because then in balance, the US will be able to have a more constructive price. Whereas right now, if the UAE says, I'm not doing this, oil is going to fall to 25 bucks. Like, there's a lot of one single risks that you could have oil drop 10, 15 bucks overnight. And I think that's a big risk for companies to take right now.
So for the companies that still have rigs out there running, they're still, still actively progressing to get more oil out of the ground. I think, for today's episode, it was called I Told You So. What would you say to them?
Well, I mean, so I think there's two things happening. Number one, we saw a low of frac fleets being run of 45 in about June. The last week's frac count that I saw was 135. So companies have tripled and oil is still 40. Now, why are they doing that? Because they're masking the fact that their base declines are 30 to 45%. And so what they're doing is in Q4, they're trying to frack a whole bunch of new wells so that their December volumes look high, so they can tell the market that when you compare December of last year to December of this year, we only had a 20% decline, but it's going to look like a curtain. And so, number one, they're fracking wells for reserves. They're fracking wells to mask declines. They're fracking wells because their cash flow is getting crushed. And so when it comes to rigs, you can't book PUDs if you don't have rigs running. And so I think part of what we're seeing is companies are like hiding the pickle by picking up rigs right now to drill a little program so that they can get their borrowing base and everything settled. And then they'll ramp back down in Q1 if oil prices haven't responded to 45, 46, 47, 48, which there's no fundamental reason that it should, unless you believe the US dollar is truly going to depreciate 20% this year.
Which you definitely don't want to see the dollar depreciating and causing oil to go up. That's probably not the most ideal solution.
No, I mean, Citigroup actually came out with that report earlier this week that said that they expect that the US dollar versus a basket of currencies will drop 20%. And I'm like, but every other country is way worse off than we are. So how can our currency drop? And if that happens, inflation, the cost of goods, the cost of living, I mean, it's just super, super bad for the US if that truly comes to pass.
So what are your thoughts on some of the mergers and acquisitions that have taken place over like the last 3 or 4 months? There's been a handful of them that have come to light. And then if you have any predictions on any of them that might be coming down the pipeline.
So I really the Chevron Noble one, I think was good. I think we've talked about this, and if you followed me at all, you know that I use the SMOG method of valuation. So SMOG is standardized measure of oil and gas. It's reported every year in a company's year-end reserve reports. And what they do is they take the PDP and they take a 5-year development plan with expected costs and curves and timing and production, and then they run a flat price deck. And for 2019, that price tag was $55.67 a barrel oil. Doesn't that sound sexy? And $2.57 an MCF. This year, we're going in at like 40 and 2. So for all intents and purposes, every public company will have almost all their PUDs written off so that their value on SMOG 2020 will be their PDP at $40 flat. When you take debt off that, you're going to find that a lot of companies are going to look really, really, really overvalued. But the reason I like the Chevron Noble deal is obviously Noble has a big position in Colorado. Chevron got comfortable with that position looking at Anadarko, which it didn't win. And from a SMOG basis, Noble was worth about 10 a share, and Chevron got them at about 10 a share. And Chevron was trading at 85 a share. And in my opinion, at 55, they're worth like 50 a share. So there was a huge value accretion that was done for Chevron. The same thing happened with Conoco Concho. Conoco to me is a $17 stock at 55 flat. It trades at 40. And so they were able to accrete value by taking on Concho. And then obviously they're going to lay off a huge number of heads and have capital efficiency where they drill less. So that's where they're getting their synergy. So I really like them. My wild card, although a lot of people disagree with me on this, Exxon should buy EOG. EOG is running out of inventory, and EOG is probably the best run E&P company in the US, in my opinion. They have very, very low debt. They always find new plays. They own the supply chain. And I think Exxon has a lot of good land, but a lot of bureaucracy. So if I were Exxon, I would buy EOG, and I would have EOG run my entire onshore US operations. So that's my big call. I think we're going to need to see some huge mergers. And with oil sitting around 42 and some stocks kind of coming back, I think we're going to see some coming into the end of the year and first quarter next year.
I will say I have heard some rumors about the Exxon EOG thing. But granted, those are just rumors, and, you know, I don't know anybody.
We need more, right? I mean, again, and I hate to say this, but you don't control price. The only thing you can control is your G&A. And so because we used to run, when I started the hot take of the day in November of 18, we were running 950 horizontal rigs in the country. Right now we're at 250. So that's 80% reduction. We were running almost 400 frac fleets. We're running 135. That's almost a 65% reduction. All of those activities come with people. And if you're not drilling as fast, you're going to cut people. And so that's the net. You and I were talking about this going back to September. And I said, let's talk in Q4. We haven't seen companies come out with their 2021 budgets yet. But I suspect when you do, they're going to be way down from 2020. And that's when they're going to continue. Like Exxon is no longer contributing to the 401k. You know, companies continue to lay off, continue to merge, continue to lay off. And I think we're going to continue to see that, unfortunately. It's very hard to see.
What do you see as far as some of the service companies on that side? Because we really haven't seen any, you know, I know QES and KLX did a merger.
Yeah.
As far as like publicly traded, that's the only one that comes to mind.
Liberty took over Schlumberger.
Yep, that's right.
And I think, you know, again, it's a horsepower question, and you're seeing. So I did a post last week on DUCs, and I mean, people who are working in the Bakken or in Oklahoma or in Haynesville know this, but in every basin except the Permian, industry has not grown DUCs. So that is drilled uncompleted wells. They've been, and in particular in the Niobrara and the Appalachian region, they have sucked a huge number of DUCs down over the last couple of years. But in the Permian, just going back to 2016, so in 2016, oil prices were low. So presumably companies were only drilling good wells. They've grown the net DUC count to like 2,400, and they're completing 150 wells a month right now at the current pace, which means they have 15 months worth of inventory that they could go complete before they have to drill any wells. The historical run rate on that is 7 months. So again, back to this, I think industry is making the same mistake. I think you're going to continue to see a ramp up in fracturing activity, which will be good short-term for service companies, but it's going to be bad long-term for price because the U.S. isn't going to be allowed to decline to where it should be. It's going to have a little resurgence, and the world doesn't need more oil right now. Like OPEC is shutting the taps on 7.7 million barrels a day. And the thing that is baking in optimism is everyone's like, oh, good. Well, they'll leave the taps closed for another 3 months in Q1. That'll be really good for us. Well, when a guy can turn a tap and doesn't have to spend any money to bring on oil, that should be very concerning. And if we didn't learn that in 2020 and 2014 and 2016 and 1985 and 2002, like, what are we doing?
Do you think that at any point in time the industry will wisen up, or do the service companies need to have an intervention with the E&P operators and say, no, we're not going to do anything for 6 months?
Well, I've heard that there's some more creative deals being done where there's sort of like float finance where a service company is trying to keep their rigs going. And so they're sort of like providing the services for free to get paid back from revenue. They're doing some stuff like that. But fundamentally, the thing about capitalism is we're all selfish. And that's why it's so funny, this lockdown and like wear a mask for your neighbor and stuff like that. It's like the whole reason our country works is because of individualism. And Ayn Rand wrote a book called The Virtue of Selfishness. When you're progressing your own self-interest, the rest of the world benefits. But in the E&P world, you know, there's so many companies that are just on the verge of bankruptcy and they're doing everything they can to keep their jobs as a management team. So they're just going to go to whatever service company will do the work. And so a service company would be crazy to not let them, like, to not bid it, but it's going to continue to exacerbate the issues and make sure you have a very good pay up front plan if you're expecting cash, because a lot of these companies don't have the cash flow to be able to pay for the services.
That's very true. I've seen many of companies that have fallen on hard times because of non-payment from, you know, the clients. So that's not, definitely don't want to see that. So as far as, you know, obviously we have a lot of these different elements that are taking place, you know, like we talked about, you've got the politics, we've got the ramp up that's going on right now. I know you had talked about in the past that, you know, you weren't getting the calls for you to join the boards of some companies. What would you, if you were put in the position of being selected to be put on a board of one of these E&P companies, what would you be telling the management team?
Well, I mean, number one, we have to survive, and survival is mergers. And so the unfortunate thing that I've seen, and like when you look at the and I had Clay Gaspar on the podcast, and if you want to hear more about the Devon WPX deal, it's a good one. And this is not a knock on them at all. But in the Concho-Conoco merger, Tim Leach, Will Giroux, Jack Harper, the most senior people at Concho, all kept jobs at Conoco. At WPX being bought by Devon, Rick Moncrief, and Clay Gaspar are going to join the merged firm. So you're seeing senior management who are preserving their income at a time when all their employees are losing jobs. And so, again, you can't like snap your fingers and be like, you should have saved 2 years ago because you're not going to have a job now. But as a board member, I think it's extremely important to rationalize costs, which include headcount. I think mergers are a huge way to do that. You need to restructure your debt to the best of your ability to convert that debt to equity, because debt always has to be paid. Equity can go to zero. And so the reason companies go bankrupt is they can't pay their debt. So you need to do that. And then the last one, and I think this is extremely important, is hedging. And I know, you know, there's a comment out there by LinkedIn user that says oil price will pick up by Q4 2021. I don't disagree. You know, fundamentally, underinvestment is going to lead to declines. Declines lead to a supply-demand imbalance, which leads to rising price to encourage investment. But the question is, will companies be around? Will they still exist by the time those prices come back? Because at the core, shale is not economic to drill wells at 42 a barrel. They just aren't. And so if oil goes to 30 again, because you have a hiccup, I mean, think of all the companies last year at 55 or 50 that didn't like that price. What would they give to hedge it for all this year at 50? Natural gas 2 weeks ago, when they expected there was going to be a cold winter, natural gas was $3.30 on the strip for like a year and a half. What natural gas player would not love $3.30 an MCF? But no, very few, I think, hedged. And then all of a sudden it looks like it's not going to be cold and gas has fallen to $2.70. And so you went from wildly profitable to speculating on gas prices and getting crushed. So the other thing as a board member, you absolutely have to hedge your returns, because this is a drill your returns business. So know the price, know the cost, know the inventory, drill the wells, convert them, and then live to fight another day. I think it's exceptionally important, and companies aren't thinking about their business properly.
So you said something that's really interesting that's been taking place, is you said the amount of investment that's coming into the industry. So, you know, I've heard from, you know, people that are on the service side and on the E&P side that like private equity money and Wall Street money is like drying up as far as our industry is concerned. And, you know, obviously you can read anywhere on the internet that, you know, there's a lot of investment money that's going into renewable and natural resources and things of that nature that are pushing those energy products forward more. Is that something, obviously in the short term, that's going to hurt us a lot? We're going to lose, some companies like you just mentioned, but in the long term, when prices potentially do rebound, if we can take our foot off the gas a little bit, is there a silver lining there at all? Or is it like that should really be the red flag that we all pay very close attention to?
So let's talk about investors in our industry. Now, in 2014, 2015, let's say 2013, when oil was still 100, companies were trading at 7 times cash flow on $100 a barrel, and they were buying assets that only worked at $100. Now, we always talk about the technological innovation our industry did to lower costs, but really the Permian wasn't really being drilled horizontally on the same scale as the Eagle Ford and the Bakken in 2013-14. All of a sudden, more service equipment was available, oil prices fell, and it turned out the Permian was like 4,000 feet of pay, multiple zones, better than any other zone, and cost came down enough that would make sense at 50. So we started drilling it. But in terms of the investors, we were still paying 7 times cash flow. But for those of you who are reservoir engineers, if you take the 1,000 barrel a day IP and convert the first month cash flow into some like annual cash flow, and you ask what a well should trade at, it's like 2 or 3. And so, again, this smog analysis, I think Exxon is a $10 stock inherently based on the fundamental value. It trades at 40. So investment bankers in New York were saying, oh, we're so concerned, David, about environmental and social and governance, and we can't invest in your industry until you fix that. Well, we didn't really fix it. The governance, Conoco added Al Walker to their board after he changed the terms of the executive compensation package the day before Chevron bid them. And the top 5 people at Anadarko got $300 million that was agreed to by the board the day before Chevron's merger. Al walked away with $100 million, which was good payment, because if you sold Anadarko at 73 a share, and right now it would be trading about 8. So I can't deny he was the smartest CEO in 2019. But then Conoco, after his incredible governance, added him to the board of Conoco to help with their governance. Like, are we kidding ourselves? And no one cares about E or S or G. What happened 2 weeks ago after the election was there was money flow that went from short oil to long oil. Oil went up 15%. Any company with high debt is heavily torqued towards oil price. And these guys wanted to buy stuff. So they went and bought the shit out of Exxon and drove it up 15% in a day. That's not ESG. Bankers would sell their grandma for $1 if they could. They just want to get money and fees. And that's what it will take for investors to come back in the industry. But fundamentally, we're still way overvalued. And so I think this rally fades. It's not investment advice. But at the core, $40 a barrel does not work. And these companies can't support their stock prices. Exxon in the first half of 2020 had $6.5 billion of operating cash flow, $11 billion of investment, and paid $7.5 billion in dividends. So $18 billion of cash went out the door for $6.5 billion of cash coming in the door that they financed with debt. Does that sound like a good operating business to you?
No, not for me at least. I mean, I can't deal with numbers that big. I stick to things that cost less than $100. So back to the other question though, so what happens as we go forward now that, the investment money is kind of private equity and some of the smaller companies, obviously the bigger companies, if they see oil jump up, like you said, the bankers will jump on it right away. And then all of a sudden there'll be a quick influx and stuff comes down. Do you foresee the industry actually getting to a point where they're like, all right, let's just run off of cash flow. Let's stop using so much debt or financing or leverage. But then when prices do go back up, does that mean like all of the gold rushers come right back in?
I mean, I would say I would answer that in 2 ways. First, all the rock worth owning in the United States is owned by someone. So it's already in a company. And therefore, there's a capital structure in that company which is comprised of shareholder equity and debt. If they don't have enough cash flow to pay the debt, the shares will go to zero. The creditors, like they did with Oasis, like they'll do with Gulfport, like they did with Whiting, like they'll do with Lillis, they'll like with Extraction, Chesapeake. The shareholders will get converted to zero. The creditors will take some of the debt, they'll convert that to equity, and then they'll leave as much debt as they possibly can on the company, because the creditors don't want to give a free option to people. And so if prices respond, then that will be a good business. But the creditors fundamentally own that business. And so I don't think the gold rush that we saw from 2008, like if you think about what happened in 2005, we were short natural gas. Aubrey McClendon was saying coal is bad. I really care about the environment. We don't need CO2 emissions. Natural gas is the greatest. Build natural gas. And everyone started drilling natural gas like crazy. And natural gas peaked at like 12, 13, 14 an MCF, if people can remember that from earlier in their career. And then there was so much of it because we were so good, we basically drove it into sustainably 250 an MCF for the last 6 years. So when you think about oil, it's the exact same thing. We went horizontal. We brought all this oil on. Everyone went crazy, but there was all this rock that wasn't owned for horizontal. So private equity jumped in front of all the public companies and bought as much as they could. And then over the course of time, they sold. Well, now all the rock is owned in public companies and some very few private ones. So there's no real gold rush that can happen. What you may see is a company like Exxon sells an asset in 2 years for $1 billion, but those assets are typically going to be non-sexy PDP, kind of like low value, because they high grade. So unless there's a huge change that, I don't know, like you can go horizontal upside down or something that changes things, I don't think you're going to see a gold rush for it. You're just going to see the industry shrink and shrink and shrink and shrink, and we'll import more oil every single year from now until the end of oil.
Oh,
the U.S. will never go back to where it was November 2019, which was 12.8 million barrels a day. It's not possible. We weren't making money drilling to 12.8 because we were using so much debt. But now that we're here and we have no access to capital, we will never get back to 12.8 million barrels a day. I would be shocked if we ever get to 11 million barrels a day.
Wow, that's a lot to swallow right there. Wow. All right, guys, if you guys have got any questions, please keep them running in here. We did have a couple of things that came in here. I do want to put this one out. Exxon can't leave a good operation alone. Just look at what they've done to XTO.
Well, yeah, and they bought XTO at the peak of the gas market, right? And again, that's the key. We are a commodity business. I don't care how good your management is and how good your technology is. If prices don't cooperate, you cannot make money. And that Exxon XTO example, I think, is the absolute poster child of that. Any good news? I like that.
Any good news are all doom and gloom.
Well, I mean, so look, this is the state of the energy industry. I think the good news is the world is now very different than it was a year ago. We have 20 million Americans out of work. We have a changed industry in terms of work from home, business travel, leisure, commercial real estate. How does education change? How does politics change? How does capital raising change? So all of a sudden, the world has changed. And so every employee in energy has the opportunity to pivot out of the energy industry and have a great opportunity to work in a brand new business that's a growth business that's responding to new challenges that didn't exist before. And, you know, I am deeply concerned about the valuation of the market. Like Tesla sells 500,000 cars a year. They make $600 million a year from carbon credits that they sell in a market that doesn't exist. And they trade at more than 30 times sales. They're 1,000 times price to earnings, and yet they add to the S&P and they trade up 20%. So there's a whole bunch of issues that are going to come in the overall economy. But for Main Street, there's going to be opportunities to move into, what do we do with schools, right? Like right now, all these kids, my kids are home. they're not learning anything online. And so wealthy families might pull their kids from schools and hire teachers, which means that the gap in public schools is really bad, which means it will be the job of some private enterprise to build a school that caters to low-income kids using commercial real estate in downtown Denver that's empty because there's nobody that works there anymore. And so the good news is you can reinvent yourself anytime. The bad news is the industry that we all love and that we've had a wonderful run in is just fundamentally different and changing because it's fundamentally a commodities business, and the world hates fossil fuels right now. And whether we like it or not, that's just the way it is.
So we kind of mentioned it a little bit before, but like with the new technology and the oversupply that the industry is going to be going through, all right, here with service companies in particular, do you think that brings down the cost of being able to drill some of these wells enough to be able to make some of the wells profitable?
I mean, certainly possible. If you write off the entire value of service companies and then you just have the iron that's free and people, presumably you could drive costs down, but that's bad for if investors can't make money doing that. What I'd suggested on a previous show was, there used to be 950 drilling rigs and now there's 250 that are working. If I were a drilling company, I would blowtorch all of my surplus so that no one could buy it for free, like for pennies on the dollar, and then put it to work and undercut me. So I would be scrapping all the surplus equipment that existed so that I would never have the pricing power be taken by a new entrant who paid a cent on the dollar for frac equipment in a drilling rig and then undercuts my ability to make profit. So I think that might be a trend that you see happen as we sustain. I would say we're going to sustain below 300 rigs and below 150 frac crews probably for the next 2 or 3 years, which is about the level we're at now. So that's sort of where I see that.
I mean, I for one will say, if we're just steady, I'll be fine with that. A lot of the volatility, if all the volatility goes away, we could just say steady. That I'd be perfectly.
I agree. Steady would be great. If we just maintain this pace, U.S. oil will flat to decline. Natural gas will continue to be flat-ish. Again, 4 million barrels a day of U.S. oil is going to be taken off the market due to natural declines in the 18 months post-COVID. And the average oil well in the United States that produces associated gas has a GOR of 4,000. So 4 million barrels a day times 4,000 GOR is 16 BCF a day. You take 16 BCF out of 110 BCF market, that's about 10%. That's good for natural gas prices. So natural gas prices should move up and be 3 to 3.25. And therefore, I think there will be people who can invest in natural gas sustainably at a good level and then hedge so that they can just maintain a level of activity that's profitable. So that's the ultimate good news story for oil and gas is natural gas is going to have its heyday as a result of this. And so if you have natural gas prospects or if you're at a natural gas company, that's the place you want to be, in my opinion.
So East Texas and the Northeast.
East Texas and the Northeast.
All right. So we do have some other questions here. One guy said tariff on foreign oil ?
So I wrote a paper for the Department of Energy in March. So I went on CNBC March 18th and I said oil is going to hit zero. And I was one of the first people on television, talking head guy, to say that. And the reason was because of inventories. And so I wrote a white paper that week for the Department of Energy that said, look, oil is going to hit zero, which means operators are going to continue to try and sell it because they have debt covenants. So the best way to control that is, number one, we need tariffs on imported oil so that we raise the price of internal barrels, and then you could use those tariffs. But what tariffs do is they really hurt the refiners and they really hurt the consumer. And the consumer only cares about getting cheap gas in their car. And the refiner can't afford, because of the blending, they always need to use foreign oil that are different crudes than the light sweet we produce here. So all you're doing is you're raising the cost to refiners, which already have, refiners are running at 77% utilization, which is their lowest in 20 years. So all the refiners are getting absolutely crushed. Crack spreads are horrible. Tariffs make that worse. And from a consumer standpoint, you only ever care about the price of gasoline. So that's why foreign tariffs don't work. But also from the American consumer perspective, like energy independence was important when we thought there was going to be war in the Middle East and that we weren't going to have security to oil. If we truly are converting to natural gas and electric fleets, we need less foreign oil. And the concept around American energy independence has always been a lie. The best we can do is produce a lot of natural gas, but from oil, if we can buy it from Saudi Arabia for $35 a barrel, we should do that. We should do as much of that as we can because we need $50 a barrel oil to be profitable in the United States.
All right, so we got another question here. German just said, how do you see the stability in midstream side? It seems that they are steady so far. Is this because of existing stored capacity?
So again, midstream is different, right? Because it's such a highly levered business. You buy pipe and then you get fixed contracts, which you then go to the bank and you sell a debt covenant and you have this huge leverage built into them. And so there's an assumption that volumes aren't going to decline, but volumes are going to decline. And so, I agree that midstream companies have hung in better, but they're fundamentally built with a house of debt in a declining commodity production level where the only way they get incremental returns is to invest new capital in new pipe. So I don't love the midstream business. But again, if you're at a midstream company, all you can do is cut costs and manage things. Building new projects right now makes very, very little sense. So, midstream was very overbuilt for this huge growth profile we were going to have. And now we've seen in the Northeast with gas, a whole bunch of projects have been canceled. And in oil, a whole bunch of pipes they just opened up in the Permian are empty. Other than DAPL, the Dakota Access Pipeline, which is shut in to the last time I checked. So we have huge differentials coming out of the Bakken. Like we're basically overbuilt on all pipe, and we have environmental activists who want to shut down new buildings. So it's just a tough overlay for our industry, which is why COVID was so important when I started writing about it, and why it was so important to get the message out that like we knew this wasn't bad in March. And I know 250,000 people have died in the United States, but 50% of them are in nursing homes. And I want you to think about that. Life expectancy is a thing. Like you're going to live to 80 probably, and then you're going to go to a nursing home because your kids don't want to take care of you, and then you're going to die in the nursing home of something. It could be an STD. STDs are rampant in nursing homes because you're at the end of your life. But when half the people die in nursing homes and the workforce of America is generally under 50, and you have a 99.92% chance of surviving, fact, CDC, under 50, healthy. The CDC has not once said why you should work out every day. They have not once said eat less carbs because it's bad for your insulin resistance. They haven't said stop drinking, stop smoking, get healthy, and go to work. And so because of COVID, the change in demand, the change in crisis, that's why the energy industry, we would have had $60 a barrel this year had it not been for COVID. And so I blame, we assassinated an Iranian general January 3rd and oil was 62. But then China started having 3 million barrels of demand destruction through January because of their COVID lockdown. Oil went from 62 to 50. Then the Russians said, we kind of don't like this OPEC thing on March 6th. And oil went from 50 to 40. And then the Saudis said, oh, you don't like it. Watch this. We're going to increase our production to 12 million barrels a day, bitches. Mic drop. And then oil went to 28. And so that's what COVID did. So if you support the lockdown and you support everything that's happened, then you're responsible for why oil is 40 and not 60.
We just said, Eric Allen says, hiding the pickle starts in nursing homes.
It does start in nursing homes. And honestly, like when I get to a nursing home, man, I'm doing drugs. I'm going crazy with the little old ladies, the little old guys too. I mean, who cares? You're at the end. You're at the end. Let's embrace that. Live the best life you can for today, and we got to worry about the debt the federal government is putting on our kids.
All right, so I want to circle back to something that you'd mentioned earlier about Tesla selling all of their carbon credits, which I don't understand that business at all of selling.
Yeah.
I don't even know how to explain it because I don't understand it so little. But I do know that we had Matt Flannery on from Stratum Reservoir a couple of weeks who talked about how older wells can now become storage facilities for carbon. Is that maybe potentially with the whole ESG movement, if we could spin it right, say, hey, look, all these wells that need to be P&A'd, now we can turn them into, storage facilities, like a U-Haul storage facility, but for carbon.
So I'm a libertarian, and so I don't love regulations. The only way a CO2 market works is to create regulations where there is a cost of an existing company that's profitable to emit CO2. And through regulation, which should be read as some politician figured out how to make money off it. Because the only reason we ever do anything is to make money. So what I do is I say, I'm really worried about the environment. We need carbon credits so that bad David Gibson over here who's making CO2, even though that's what you do by breathing, but let's not worry about that. But you're very bad because you emit CO2 through the production of oil, which is then used in cars by consumers. But we don't want to blame consumers for burning oil. We want to blame you, big bad oil company. So you're going to have to buy credits for 30 tons of CO2 at $30 a ton. Okay, so then I give money from you to me to pay for my carbon credits. And you know what happens to CO2? Nothing. But you know what happens is then Tesla has fake things because their cars are avoiding creating CO2. Beyond Meat makes fake meat, so they don't need cows. So Beyond Meat can have carbon credits because they have fake cows that aren't real cows. They can sell the CO2 they otherwise would have created had they been real cows. And then we're going to take money that the oil company just bought or just paid for CO2 credits and give it to a fake meat company that's fake cows doesn't make CO2. And then Beyond Meat's going to get money, which shareholders are going to get. But you know what? There's a little transaction fee, says the regulator who just put in the laws that include the carbon credits in the first place. And now I am a billionaire and I don't effing care. So that's how Tesla has been funded and subsidized, is through the creation of a carbon market in California by not creating CO2, even though 30% of the power grid in the country is coal. So when you plug in your Tesla, 30% of that electricity charge comes from coal, and some comes from burning wood in the big biomass, which if you haven't seen A Planet of Humans, it's a phenomenal movie and will scare the hell out of you about renewables, because biomass is considered renewable. So if you burn a tree, you'd imagine you create a lot of CO2, right? But if you plant a new tree, you can offset the old tree, so it's renewable. So if you're a coal company and you just planted trees, you'd also be renewable, but you're burning coal and planting trees, which is bad. But burning trees and planting trees, that is good. It's definitely worth watching if you want to be a little more cynical on the environmental movement.
Yeah, we planted some tomato plants in the backyard of my house, and so that offset Gibson reports to be carbon neutral. So we took that to we haven't publicized and told everybody.
Yeah,
but we did do it.
But so the answer to your question is, will P&A wells be good? Yes, if a regulator steps in and creates some market where then there's some technology where you could suck CO2 out of the air. I believe they're called trees because that's what they do too. But you could take trees and turn it into a compressor and suck CO2 from the sky and then pump it into a well, which CO2 is highly corrosive, and so it's probably bad, and then you're going to have CO2. So we worry about groundwater. So now we're going to have carbonated groundwater from all of the eating of the casing based on the compressed CO2. Or we could just accept that since CO2 emissions this year have dropped by 9% and nothing has happened to the planet, that it is probably going to get hot and the sea level probably is going to rise. And but also there's parts of the world that can't grow food that now are green. And so maybe there's more greening, and maybe that we should really just focus that population is a problem and that we can't have 7.8 billion people on the planet wanting to live like Americans, because if we did, then we would destroy the resources of the planet. And so we should have less people. And that is the best form of climate change that you can have.
I think maybe we could start a carbon neutral movement by saying, hey, everybody sit on their couch and breathe as little as you can for 30 minutes. And then you just don't create as much carbon. And then we can collect all of those for everybody who signs up on the website. We get one of their carbon units to sell to whomever else wants to buy them. So we have Brian Duya says,
can I just pull up one thing? I want to
Yeah.
There's the problem is that 40% of the positives are 20 to 29 and they go visit their grandma or their parents. Again, the issue in March was flatten the curve, because society would have broken down if hospitals were not able to take people. The reality is, if you are a parent and you're not healthy, you don't need to see your kids. You can lock yourself in the house. Grandma and grandpa can wear an N95 mask, not a surgical mask, not a cloth mask, not a t-shirt, not panties. You can wear an N95 mask. You can sit 20 feet away from people. You can stay away from people and let the people like people between 20 and 29 are getting this and feel no symptoms. None. So why are we shutting down their life, their ability to pay for their jobs, their houses, their cars, their kids sports? The whole reason we live is to take our kids to sports and hang out with friends. And because grandma and grandpa can't sit in their own house with a mask themselves, we have to shut down the entire planet. That is just illogical. The whole, don't you care about grandma? Yeah, but you know what? Grandma's going to die, and my kids have to be able to have jobs and pay for the economy, pay taxes, because taxes pay for schools and teachers and hospitals. And without a tax base, the economy is fucked. So that's my response to, I do care about Granny and Grandpa. I just care about my kids a lot more.
All right, David, thank you so much for being here today. Any last words, anything else that we could do with your movement of being able to get you back on LinkedIn? Because it will definitely spice it up a little bit more.
For sure. I mean, and again, I don't want you to agree with what I'm saying. And I say it in a very colorful, loud way to stimulate you so that you can either be challenged and double down on your opinion or move your opinion a little bit. But this is a caricature of a guy who I truly believe what I say. I say it in a passionate way to communicate a message. But I believe if we don't have people from both sides of the debate voicing things, sharing data, and educating people, we lose so much as a society. And so if you believe that it is not the job of a social media company to decide that they think COVID is very scary, and so based on you telling people that there is a virtually 0% chance of dying under 50 being healthy, if you believe that someone should say that and not get banned, then I would encourage you to like the post that we shared, make your own hot take of the day and share it with the hashtags that we talk about. And hopefully LinkedIn will come to their senses, because one way or another, Section 230 protects against liability for social media companies. And so if they are having a platform where they allow people to say anything they want, Section 230 protects them. They can't also then choose which voices they want to have and have not, because that is censorship and violates Section 230. So they need to regulate this as a utility and exist and let people talk. That is all I ask from you.
You know, I have to agree with this to the simple point that, like, some people can get on there and rage about Bitcoin, or they can talk about selling their sales class, which we all know they're lying about, and they're spreading false stuff. They're taking money out of the hands of people who are naive. So what's the difference between them expressing their opinion and talking about themselves versus you being able to talk about, what's currently happening in our, country?
And shouldn't we be able to make up our own minds by reading things? Like, do we need mommy and daddy to tell us that we can leave our house and that we should work out, and that this is good things for you to read and this is bad things for you to read. Because if this was really about health, they would have locked down McDonald's, because that's bad for you. Carbohydrates are bad for you. Smoking is bad for you. Drinking is bad for you. If it was really about health during the lockdown, they would have shut down liquor stores, stopped selling cigarettes, shut down all fast food, and made everyone eat vegetables and meat. And then we would be not, 32% of Americans are obese. 32% of Americans, this is a health crisis, but it's not COVID. It's because we all eat and drink too much. So love you all.
Definitely would have shut down the Cheesecake Factory.
No, don't do that. I love that stuff.
David, thank you so much. I really wish we could get you back on LinkedIn and whatever it takes for everybody else that is out there watching. You are still you're getting active on Twitter though, right?
I know, but I don't like my Twitter. I actually, this year has made me kind of depressed and therefore combative. And Twitter, there's a lot of anonymous people. So one of the things I will say about LinkedIn that I love, I know everyone's names. So I recognize, like, I see Jim there. I know Brian there. Like, I recognize these names, and I build friendships with people because they were real people that would dialogue. And I think that that was extremely important. On Twitter, I get it because there is a cancel culture. And so if you say bad things on social media, you will be fired by your boss. So a lot of people use anon accounts, but then that means they control and attack. And unfortunately, I'm not a guy that just like ignores that stuff. So when someone takes a swing at me, I tend to swing back. So Twitter is not my favorite platform, but right now it's the only platform I have.
Well, we still look forward to visiting your website and seeing all the stuff that you're putting out there. I know you've also got a counterpart who still has their LinkedIn stuff, who's posting all of your content. Gary, is that
Glenn Parrott?
Glenn.
Yeah.
Glenn.
No, Glenn
Sorry.
produces the podcast, and you can connect to him. I really hope LinkedIn, please, free #DRW. Come on, let's get me back on LinkedIn. I miss everyone, and then we'll come back with the 7 hottest takes yet.
David, thank you so much for being here. Everybody that's watching, please take a minute, go look at the link that's in the description of the video or the post. Go check that out. This is something that's bigger than all of us, that is actually taking place. This is, there's been a lot of people that I've seen in my personal feed who have been, I guess they've had their content pulled off of the website because of some of the things that they've posted, whether it be Republican, Democrat, whatever. Just they have content, they're putting it out there, it's getting pulled. So I personally would love to be able to have essentially the voice of our industry back into the place where we have our main meeting, our virtual meeting space, to be there. So guys, it's not about me today. It's about helping out David, get him back on there. Go check out the podcast, #Hot Take of the Day or hotTakeoftheday.com. Great stuff there. Go get you a hat. The season of purchasing stuff for other people is upon us. So get somebody a shirt that says "Hope is not a plan," so that they can be educated as well. I'm trying to think of anything else I need to say. For everybody else that's been out there watching, I want to say thanks. So we've had people that have been commenting throughout the whole. So Jim, Rodney, Lee, Gus, Kirk, all of you guys out there, and anybody else that's still watching, thank you guys so much. I really do appreciate it. This is the last episode before Thanksgiving. I want to say thank you to everybody out there who's supported the show in the past and going forward. It means a lot to me, and for the people that are supporting David and the messages that he's putting out there. He's got great educational content. So thank you all. Anything else, David?
Keep up the great work, David. I love what you've been doing, and I love the community you've built around it. I think these are very important, and they're going to replace mainstream media eventually. So well done. Oh yeah, what's the name of the book? The book is on Amazon. It's called "What the Fuck Is Wrong with Everybody Else? What They Didn't Teach You in Business School."
Yes, profit good, loss is bad.
Profit good, loss is bad.
I think that's where this whole thing started from. Maybe that was it. It's going to drive me nuts that I can't find that post because it was a great back and forth between us. All right, guys. Thank you guys all so much. #FreeDRW. Have a wonderful Thanksgiving. Go spend time with your family, regardless. Go spend time with them in some way, shape, or form. Just spend time with them. Cherish the moments that you've got.
I'm going to go lick my mother in a non-sexual way.
I don't know what nursing home you end up in, but I want to end up at the same one. Have a good one, David. As always, guys, know your industry. That's it.